All right, welcome to Talk Tickers. We're digging into the market's biggest stories, and today we've got a fascinating one, Central Bancompany. This was their very first earnings call as a public company, and boy, it's a real head-scratcher. You've got good news on one hand and a skeptical market on the other, so we're going to figure out exactly what's going on.
So, here's the big question, the mystery we're trying to solve today. How on earth does a stock drop after the company reports what looks like, objectively good news? It happens all the time, and it's one of those classic market puzzles. And today, the company in the hot seat is Central Bancompany, or CBC.
Okay, look at this. This really lays out the whole conflict perfectly. On one side, you've got the headline screaming, EPS beat, revenue beat. Everything looks great, right? But then, you look at the reality. The stock ends the day down almost 2%. It just doesn't add up. So what in the world happened here?
All right, let's dive into the first part of this puzzle, the numbers themselves. Because honestly, on paper, CBC had a really strong Q4.
First up, earnings per share. They came in at 47 cents. Now the folks on Wall Street, the analysts, they were expecting 46 cents, so boom, a clean beat right out of the gate. That's a great start.
And it wasn't just about the profits either. Check out the revenue. Over $272 million. The street was looking for something like $265.5 million, so they absolutely sailed past that. We're talking a top-line beat and a bottom-line beat. Check and check.
And if you dig a little deeper, the story just gets better. I mean, look at these core banking metrics. Net income, almost $108 million. Their net interest margin, which is basically how much money they make on their loans, a super healthy 4.41%. And return on assets, a stellar 2.17%. You just don't see numbers like that every day. These are all signs of a really well-run, profitable business.
Okay, so if the numbers were this good, pristine is the word, why did the market give them the cold shoulder? Let's trace what actually happened during the trading day, because that's where things get interesting. We'll see how that initial excitement just fizzled out.
So here's the play-by-play. Before the market even opened, the earnings report comes out and the stock is looking good. It's pointing to an open up almost 2%, around $25 a share. Everyone's happy. But then, 10 a.m. Eastern rolls around and management gets on the earnings call. And by the end of the day, poof, all those gains are gone. The stock closes down near $24.40. The smoking gun here, the turning point, was definitely that call.
But wait, here's a really important clue. The volume. Look at this. On a day with huge news, you'd expect a ton of trading, right? But fewer than 7,400 shares actually changed hands. That's a tiny fraction of its normal daily volume. So this wasn't some big panic, not a mass exodus of sellers. It was more like a quiet drift downwards on super thin volume. And when volume is that light, even small trades can push the price around in a big way.
So if the numbers were good and there wasn't a huge wave of selling, what gives? Well, the answer wasn't in the spreadsheet. It was in what was said and maybe what wasn't said during the Q&A with management. It all comes down to reading the M&A tea leaves. And here it is. This is the quote that changed everything. The CEO, John Ross, gets asked about when they might buy another bank. His answer? We're much more focused on doing the right deal than doing a timely deal. Now, on one level, that sounds smart, right? Responsible? But to a market that's desperate for a catalyst, for the next big thing, patience just sounds a whole lot like we have no idea when this is happening. And that's uncertainty. So, why is this M&A stuff such a big deal for them? Well, since they just went public, they now have this powerful new tool called M&A currency. And all that really means is they can use their own stock to buy other companies. It's like having a special kind of money just for making acquisitions. And it's absolutely central to their whole growth plan. And they were pretty specific about their shopping list. They're not just buying anything. They're looking for big deals, around $2 billion in assets. They want high-quality banks, and they're eyeing a move into Texas. They even said they're talking to potential targets right now. But, and this is the big but, they refused to give any kind of timeline. The message was loud and clear: we'll be disciplined and we'll wait for the perfect deal.
And you know what else fanned the flames of uncertainty? They gave zero explicit financial guidance, no predictions for next quarter. So investors had no hard numbers to grab onto. All they had was management's commentary, and that commentary was all about this big, important catalyst, an M&A deal that has no date attached to it. It's like saying, we're going on a trip, but we don't know when we're leaving. So, with all that on the table, where does that leave the stock? Let's get to it. It's time for the analyst's next call. We're going to lay out what to watch for, and I'll give you our official rating on the stock.
All right, so looking ahead, here are the 3 big things you need to keep your eyes on. Number 1, that net interest margin. It was great. Can they keep it that strong? That's huge. Number 2, M&A news. Is all this talk about being disciplined going to turn into an actual concrete deal? And number 3, they're expanding in St. Louis and Denver. We need to see if that's driving real deposit growth or if it's just adding to their costs.
Okay, so putting it all together, our official rating on Central Bancompany is market perform. Now, what does that mean? It means you have a company with fantastic, absolutely solid fundamentals. The business itself is great, but that huge growth catalyst, the M&A deal that everyone is waiting for, is still a question mark. We know what they want to do, and it's a strong plan, but the when is a total mystery. And in this market, that matters.
Okay, for our last segment, let's have a little fun. Let's put on our imaginary hedge fund manager hats for a minute and talk about how you could actually trade this situation.
So the big question for anyone looking at this stock is, how do you play the waiting game? How do you position yourself to cash in if they do announce a great deal without just having your money sit there doing nothing in the meantime?
Well, here's one idea. It's a classic pair trade designed to zero in on that M&A catalyst. The move would be to go long CBC, you're buying their stock, and at the same time you short a regional bank ETF, something like KRE. The whole point is to bet that CBC's unique story, their potential M&A deal, will make them go up, while hedging out all the general risks that might affect the entire banking sector. You're trying to isolate CBC's specific story.
So at the end of the day, what we have here is a story of truly pristine numbers running smack into a market that just demands an immediate catalyst. It's a company playing chess in a world of checkers, and it really just leaves you with one big thought to chew on. But that's just our take on the situation, and we always have to say it, so here it is. Remember, this is not financial advice.